For all verified facts, subscribe to our YouTube channel and click the bell icon to get the latest updates.
Hello and welcome to From the Front Lines. I'm Govindraj Ethiraj. It's been a searing run by the stock markets, but now they've taken a breather after hitting record highs. The Sensex has ended 1.6% lower today at 43,828, down about 694 points. But more importantly, it lost 997 points from the day's high, something that would have shocked people at any other time, but maybe not so much today. The Nifty, which a lot of people follow, or the NSE Nifty, dropped about 196 points. It gone below that 13,000 mark and is now at 12,858. Now, globally, unlike what many people predicted, or some people predicted, a Biden presidency has been welcomed by markets, or at least seemingly welcomed by the markets, even as there's more positive news on vaccines making their debut by the first quarter of the next calendar year. The Dow Jones benchmark has now cracked 30,000. Now, 30,000 is a very important figure because this, apart from the fact that this is a record, it also represents now an 8-month rebound since March, and this is also the best month since 1987 for the Dow. So the Dow is up 62% since then. And the Indian markets too have been roughly mirroring this, given the fact that capital flows are uniformly squishing and flooding the world and the world's capital markets and causing all of this, among other reasons. So to discuss what's happening now, is this a breather? Is this a pause before it goes up again, or is this something that investors, particularly retail, should be worried about? I'm now joined by Neeraj Dewan, director at Quantum Securities, and Ambareesh Baliga, independent market analyst. Thank you both for joining me.
Thank you.
Ambareesh, let me start with you. We spoke only a few days ago, and you did warn that there was a bit of a hiccup coming quite soon. So, is this that one?
Again, I would frankly say that I really don't know whether this is that one or not, because what we have seen in the recent past, in the last 7-8 months, is whenever there has been a correction, there has been buying coming in from the retail investors, and now we have seen FII buying also. But then again, we should remember as to what are those big risks which are, there around the corner, and I don't know which risks will actually play out. One clear big risk is that fresh lockdowns, in case they happen, although they could be partial, they'll surely have an effect on the economy. As and when those are announced, we have already had something in Gujarat, MP, in a couple of other locations, but in case that happens in Bombay, I really don't know as to how the markets would take it, surely negatively. At the same time, we have been quite gung-ho about various data which have been coming. The consumption stories, the real estate is doing well, white goods have been selling extremely well. We have seen, even passenger cars and HCV, LCVs being sold well. GST numbers, they're improving month on month. But the question again is, was this the pent-up demand plus the festive demand which got bunched up together in those 2-3 months? And we have seen extremely good figures. Whether that will sustain over November, December, January, I don't know. So that's another question mark. So I think in case any of these negatives play out, in case the demand we see is not sustainable, and those negatives play out, lockdown negative plays out, and in case we have a decently big correction, in a sense, a correction beyond 5-6%, and what correction we saw today was much smaller. In case it's beyond 5 or 6%, will the retail investors hold on, or whether they'll start panicking? Because, last 6-8 months, about 50 lakh new investors have come in. So, in case they panic, I think you could see a much deeper correction.
Right.
So, whenever we see a correction, I think it'll be a very deep one.
Right. So 5 to 6% is your benchmark for a deep correction. And I'll come back to that in a moment, Ambareesh. Neeraj, what's happening from your vantage point?
Yeah, I agree with Ambareesh that, whether this is the correction we've all been waiting for, or this is not that correction, timing the market is something which is very difficult for everyone. So, we should leave that and let's see how things pan out as far as the market is concerned. What we've seen is that there've been tremendous gush of liquidity, the likes we've never seen in the last so many years. So that is what is driving the markets right now. And this is one of the best November I have seen in the last 13, 14, 15 years. So we never got this kind of liquidity and this kind of movement. Some days back, we were looking at market, trying to cross 12,000. And today we were past 13,000. It happened so fast that, a lot of people who were sitting on the sidelines, who wanted to put in money, they also got caught by surprise and they also tried to join in the party. So there has been some selling happening from domestic institutional investors. But I think HNI, retail, which were waiting for a correction, seeing this kind of liquidity, they also try to jump in the market. And that is why we started seeing some broader participation. So whenever we see this kind of a broad participation and stocks which are not even fundamentally deserving to be at this valuation start moving up, and that's what we start seeing now. So there can be corrections. Of course, there will be corrections because we've seen this kind of a liquidity gush, but I don't think there will be meaningful correction till we see something fundamentally changing. Maybe the liquidity which has been coming dries off and some money starts going back. That is where we can see a turnaround in the market and a deeper correction. But till that time, there will be corrections, and there will be corrections which will be bought at a lower level.
Right. So let's take some of the news elements that have been driving this market, particularly in recent times. So one of them, and Neeraj, let me start with you again. One of them obviously is the vaccine, and the vaccine is now in sight, at least for the Western world, which is driving liquidity markets, everything there, or markets liquidity, and that's flowing here as well. And the other is, of course, whether this rebound is sustainable. So are you seeing both similarly, or how are you aggregating or disaggregating it?
See, basically, the fact that vaccine is now visible and it may start coming the next couple of months. You may have, some health workers and senior citizens starting to get the vaccine. So there will be some change. See, earlier we were investing, looking at the lockdown, work from home, dependence on information technology, dependent on communication. A lot of these things which we were looking at will change. So the way now the portfolios will be structured would be looking ahead how once the life is back to normal post a vaccine, how will the growth come back and what are the sectors which will look at the growth. So I would still be looking at opportunities, but then the opportunities will change. There will be structural change in the kind of stocks we're looking at the last 6 to 8 months and the kind of stocks we will start looking at going ahead. Some, of course, will remain the same because there are certain stocks which are evergreen stocks. So you will use any opportunity to invest into those stocks. But otherwise, you will have some change. Some money will flow out of IT, which has done so well in the last few months, and some pharma stocks which were more towards the cure than the vaccine, or not into normal healthcare. So those stocks may also take a breather. So there will be some change as far as the sector allocation.
Right. So, Ambareesh, if we were to, in some ways, deduct what we've seen in the last 8 months, the rebound, which of course has been an amazing and a sustained rebound, where are we then? I mean, are we, the situation going forward, as Neeraj points out, is it going to be different from what it was before March? Or is it going to have some elements? Is it going to be completely different? So basically this 8 or 9 months that we've gone down and then gone first down and then up again, what is fundamentally changing or likely to change?
The way we live clearly, and work, I think that is completely changing and has already changed to a very large extent. So I think that would be a new normal. And because of which, couple of sectors or industries would surely would be doing much better. Like for example, telecom. That is one space which I think will have a much larger role to play, telecom and IT. As compared to what it was earlier. But I would just like to mention a couple of other things. Today what we are seeing is a sort of a bubble creation. Because the sort of valuations which we have seen now is much higher than what one can logically reason out. And at the same time, if you're talking of economic growth being sustainable, I think all the sectors and people across all the strata need to actually be there in that economic growth, which I'm not really seeing. Because just for example, I'll give you the cement sector. In cement sector, what we have seen is, the growth or the consumption has been lower than what it was last year. But the top 3 companies have shown better performance than last year. This clearly shows that the bigger boys are becoming bigger. And, those who are suffering are at the lower end of the pyramid. Everyone there together, you really can't have a sustainable growth.
Right. Okay, let me come back to Neeraj, the point that you were making about the next 6 months and how that could be quite different from the last 6 or the last 8. Now, one of the points that maybe we have to remember is that if we were to have more lockdowns, and that might distort things a little bit. But when things come back, the economy as a whole, I mean, while we may have revised our GDP numbers a little upwards from where we had revised downwards even until maybe about a month ago, the fact is that the economy as a whole is still down maybe, minus 8% to 10%, depending on who you ask. Now, does that mean anything at all when it comes to the markets, or do the markets have their, like many times before, have their own, motivation and drive, and they'll keep going?
Yeah, markets will not really keep going like this because somewhere down the line, valuation has to match what kind of growth we're seeing in the economy. So there's definitely, that's why I said that we're not sure whether this is the correction. There's definitely going to be some correction down the way. If there are lockdowns or if there's going to be some delay in the way vaccine is going to be, transported or logistically provided to everyone, there can be delays down the line. So they're going to be corrections down the line, and economy not doing well really matters. So now just fact that we are -8 or -10 is something which will go to matter. And the kind of inflation that we've seen right now is also worrisome. So if inflation continues and the growth is not happening, there's going to be combined effect which is going to be troublesome for the market in the medium term. What I mean is that whenever you get corrections now down the line, whether it's now or within the next 3-4 months, those corrections will be used now to invest in different kind of stock than what we were doing earlier. So now we'll be looking at stocks with the benefit that whenever we are back to normal, what will be good for the market. So there's definitely going to be corrections, and market will be worried about what is happening. So the ferocity or the duration of the correction will depend on how things are panning out and how things will come back to normal.
Right. So what is this new bucket of stocks or sectors looking like, Neeraj?
There are stocks which will benefit once we're back to normal, whether it's the entertainment side of the entertainment sector. Then, you have stocks which are anyway benefiting because of shift from China. So there you are anyway, companies like chemical companies are benefiting. And when things are coming back to normal, they will get further demand, which will boost their profit line going ahead. So that these, whether it's chemical, whether it's entertainment, then there's the retail sector, which is totally dead right now. People are not going out and shopping. So retail segment is totally dead or really not growing. So there also you will start coming back. And what has happened in the last 6 months is everyone has tried to get their costs low. Wherever they felt there was a little bit of flab, they're cutting it. So when they come back, adding that cost will take a lot of time. So the profitability in the initial stages, whenever things come back to normal, can be higher than what they were doing pre-COVID. So these are kind of sectors, we'll be looking at whenever there are corrections or opportunities coming down the line.
Right. And Ambareesh, before I come to you for your bucket, if it's a new bucket, Neeraj, do you see retail investors panicking if we see a 5 to 6% correction?
Yeah, definitely. They will be panicking because, a lot of the investors are new investors also, which jumped into the market in the last 9 months. So those are the people who not really seen decent correction. We saw a correction coming in when the market was 11,800. It came down 1,000 points in the Nifty very fast. But then, got that buying coming back and it was supported. But if there is a 6-7% correction now and you see stock correcting, and people who come into the market in the last 8 months may not have seen that kind of a correction. So they will definitely panic.
Okay. Ambareesh, last word. What's your new bucket looking like, or what could a new bucket of stocks or sectors look like as you look ahead in this? I know we are poised delicately. Yeah. We may see some lockdown coming back, but assuming even if there are lockdowns, they will be mild. What's the near future looking like?
The bucket which I'm looking at now is a combination of what I was looking at, say, about 6-7 months back and some new ones. For example, real estate, I think, is coming back. And when we talk of real estate, I think it's going to be only affordable housing. So, quite a few of the listed entities are out because most of them have been in luxury real estate. But affordable, I've clearly seen, is actually bouncing back, especially in the last 3 months. Then in consumption again, FMCG at the lower value FMCG, I think that is where there is still extremely good demand because a lot of people are shifting to branded. than the local FMCG produce. And at the same time, the old bucket which continues is clearly specialty chemicals, which I think would be in an extremely good position as far as India is concerned. And the other new bucket which is there is export-oriented home textiles. I think that is one where there's a huge opportunity because I think China would be losing out as far as US is concerned.
Right, that's an interesting one. So both of you have mentioned the China factor for slightly different reasons, but it is a fact that as either imports into India get constrained as they are, or imports into countries like the US get constrained, the opportunities for Indian companies who are exporting to those markets increase. So all in all, a new bucket is emerging, new opportunities and potentially new ways to get into the market in case if you are looking at. Neeraj Dewan and Ambareesh Baliga, thank you very much for joining me.
Yeah.
Thank you.